Ever wondered why seemingly smart people throw their life savings into something that looks, in hindsight, like a complete fantasy? Think about the Dutch tulip mania, the dot-com boom, or even the recent crypto craze. What makes us jump on these bandwagons convinced we've found the golden ticket? It's not just about charts and numbers. The real story is happening inside our heads. Today, we're diving deep into the psychology behind economic bubbles and uncovering the invisible forces that drive us to invest, sometimes against our better judgment. So, what exactly is an economic bubble? Simply put, it's when the price of an asset, like a stock, a house, or even a flower, gets inflated way beyond its actual value. It's a party where everyone's having a great time, the music is loud, and it feels like it'll never end. But like all parties, it eventually does, and the hangover can be brutal. The bubble bursts, prices crash, and a lot of people lose a lot of money. To understand why these bubbles form, we need to talk about one of the most powerful forces in human behavior, herd mentality. We're social creatures. We look to others for cues on how to act, what to believe, and yes, where to invest our money. When we see our friends, neighbors, or even strangers on the internet making a fortune from a new stock, a powerful feeling kicks in. It's called FOMO, the fear of missing out. We think, if they're all getting rich, why can't I? I must be missing something. This fear is a primal instinct. Back in ancient times, straying from the herd could mean getting left behind and facing danger alone. In the financial world, it means watching from the sidelines as everyone else seems to be winning. This herd instinct creates a feedback loop. As more people buy in, the price goes up. The rising price attracts even more people, which pushes the price even higher. Logic gets thrown out the window. People stop asking, is this company actually profitable? Does this asset have any real-world use? The only question that seems to matter is the price going up? The rising price itself becomes the justification for buying. This is classic herd behavior, where the wisdom of the crowd turns into the madness of the mob. We assume that if so many people are doing something, it must be the right thing to do. But in a bubble, the crowd is often running together right off a cliff. Now let us talk about the two emotional puppet masters that pull our strings during a bubble, fear and greed. These are two of the most potent human emotions, and they can completely short-circuit our rational thinking. Greed is the engine of the bubble. It's the whisper in our ear that says, this is it, this is your chance to get rich quick. Just one more trade, and you'll be set for life. Stories of overnight millionaires spread like wildfire. We see someone who bought a little-known stock for pennies and sold it for hundreds of dollars, and we start to fantasize. We imagine ourselves quitting our jobs, buying a dream house, and traveling the world. This dream is so intoxicating that it can make us ignore all the red flags. Greed makes us focus on the potential rewards, no matter how unlikely, and downplay the very real risks. But what happens when the party starts to wind down? That's when fear takes over, greed's evil twin. The first sign of trouble, a small dip in price, can trigger a wave of panic. The same people who were buying frantically just a week ago are now stampeding for the exits. The fear of losing everything becomes alcohol. The thought process flips from how much more can I make, to how do I get out with anything left. This panic selling causes the price to plummet, which creates more panic, feeding the crash. It's the herd mentality in reverse. Everyone is selling because everyone else is selling. The race to the top becomes a frantic race to the bottom. In these moments, logic is gone. People will sell at massive losses just to stop the bleeding, even if the asset's fundamental value hasn't really changed that much. Another psychological trap we fall into is overconfidence. When we're on a winning streak, our brains release dopamine, a feel-good chemical. This makes us feel smart, powerful, almost invincible. We start to believe we have a special talent for picking winners. We might think, I'm not like the others. I know when to get out. I can time the market. This is the Dunning-Kruger effect in action, where we overestimate our own abilities. We attribute our success to skill, not luck or the fact that we're just riding a wave. This overconfidence leads us to take on more and more risk. We might invest more money than we can afford to lose, or use leverage to magnify our bets. We believe we've cracked the code, but in reality, we're just setting ourselves up for a bigger fall. This ties into something called confirmation bias. Our brains love to be right. So, when we've invested in something, we actively seek out information that confirms our decision was a good one. We'll read positive news articles, follow optimistic influencers, and hang out in online forums where everyone is cheering for the same asset. At the same time, we'll ignore or dismiss any negative information. A critical report. That's just FUD, fear, uncertainty, and doubt. A respected expert warning about a bubble. They just don't get it. They're old-fashioned. We build an echo chamber around ourselves that reinforces our belief and makes it even harder to see the warning signs. We're not just investing our money, we're investing our ego, and admitting we were wrong feels like a personal failure. So, how can we protect ourselves from getting swept up in the next bubble? The first step is awareness. Just by understanding these psychological biases, herd mentality, fear and greed, overconfidence, and confirmation bias, we're already ahead of the game. When you feel that urge to jump into a hot investment, take a step back. Ask yourself, am I buying this because I've done my research and believe in its long-term value, or am I just afraid of missing out? Am I getting caught up in the hype? The best antidote to emotional investing is to have a plan. Before you invest a single dollar, define your financial goals and your risk tolerance. Create a diversified portfolio that isn't overly reliant on one single asset class. And most importantly, stick to your plan. Don't let the daily market noise or the stories of your neighbor's big win derail you. A strategy called dollar cost averaging can be incredibly helpful. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. This forces you to buy more when prices are low and less when prices are high, taking emotion out of the equation. Remember, boring is often beautiful in investing. The slow and steady path of consistent, diversified investing might not make for exciting dinner party conversation, but it's far more likely to build sustainable wealth over the long term than chasing the latest bubble. True financial freedom isn't about hitting one lucky jackpot. It's about making sound, rational decisions over and over again. So, the next time you see an investment going to the moon, pause and think about the psychology at play. The pressure to join the herd can be immense, but the greatest investors are often the ones who can stand apart from the crowd, keep their emotions in check, and focus on the fundamentals. The story of every bubble is a powerful lesson in human psychology. It teaches us that our biggest financial enemy is often the person we see in the mirror. What do you think is the strongest psychological force that drives people into bubbles? Is it the fear of missing out, or the simple greed for quick riches? Let me know your thoughts down in the comments. I read every single one. And if you found this look into the investor's mind fascinating, do me a favor and hit that like button and subscribe for more deep dives into the world of finance and psychology. But here's a final thought to leave you with. We've talked about how bubbles are driven by emotion and irrationality. But what if the next great bubble isn't in stocks or crypto? What if the next bubble is forming in an area we're not even watching, driven by a new kind of human desire we've never seen before? Thanks for watching.